Welcome to Tank Talks. I am Cinthia Murphy, Head of Research for the ETF Think Tank. And today I am joined by two phenomenal guys who have a lot to offer the ETF space, and I'm really excited about this conversation. Here with me today is Jerry Parker, founder and CEO of Chesapeake Capital, and Jon Robinson, co-founder and CEO of Blueprint Investment Partners. Welcome, guys. How are you today?
Doing well. Thanks for having us.
Well.
So, Jon, I'm going to start with you. First of all, both of you, congratulations on the launch of your new ETF. The ticker is TFPN, and I'm excited to dive into this strategy. It's really interesting. It's really unique. But before we go there, I think we should start by talking a little bit about this partnership between the two firms, Blueprint and Chesapeake. You've collaborated for about a decade. This is your first ETF together. So tell us a little bit about how this partnership came to be and why it's so meaningful.
Yeah. So from a Blueprint perspective, Jerry and Chesapeake's track record speaks for itself. So it's very easy for Blueprint to want and desire to partner with Jerry and Chesapeake. Like you said, we have known each other and collaborated and worked together for about 10 years. In fact, Blueprint was an investor in another fund that Chesapeake operates. And that's how we got to know them originally. We knew about Jerry, Chesapeake, their story, but we got to know them personally at that time. And we not only hit it off relationally, but we also have a very common, strong middle ground, which is a near fanatical belief in trend following. And so for us, as an asset manager, for Blueprint to partner with another asset manager, it almost has to be with somebody who shares a passion for trend following, for risk management, and maybe more importantly, an unwavering discipline to execute the strategy at all times. And that's what we have in our partner with Chesapeake.
Yeah, I agree with all that. I remember the first phone call I ever had with Jon and his team. And I don't think I'd ever had a better business call ever. And primarily because they liked me so much. See, that's how shallow I was and am still probably. But yeah, I mean, I just got off the phone going, wow, these guys really like what we do. And I bet you I like them as well. So yeah, it's rare to find two groups of people, two different firms who have this sort of affection for trend following or the same sort of strategy. And so it was easy for us to want to work together and actually work together.
Yeah, what I love about the idea of the fanatical belief is especially when it comes to the ETF space, it's all about conviction at this point, because there's so many different products out there, and conviction on something really stands out, whether you're talking thematics or in this case, liquid alts. So I think it's what makes this product, this strategy, and this partnership so exciting for somebody like me who watches all the ETFs that come to market and gets to know the providers and the stories. It's a really exciting strategy. So let's talk about it. Let's talk about TFPN, which, maybe we'll start right there. I love the ticker. It stands for trend following plus nothing. I'm sure we're going to have a chance to dive into why is plus nothing a differentiator here. I think it's a really cool concept. But, to start broadly, the idea of this fund, several 300 plus markets, managed futures. There's a lot, long short. There's a lot going on here. So, Jerry, just from a big picture perspective, what's the opportunity set in this space? Why is this space, ready for this type of disruptive strategy?
Well, it doesn't exist. I don't think anybody is doing it exactly the way we're doing it. We think that we love it, and we think it's a great strategy. And I was sort of selfish in creating this strategy that I liked more than anything else. And like you said, it is 150 stocks. So half the portfolio is single stocks, long and short, which we think gives us quite a bit of extra diversification, and then currencies, commodities, and interest rates as well. So trend following stocks is unusual, and not a lot of people do it. I don't think there's an ETF that does it in sort of the classic trend following way that we do it, where we truly let our profits run and don't try to take small profits or smooth out the volatility so much. We try to smooth out the volatility and bumps and the ups and downs by trading lots of different markets, long and short. And so we think this sort of, there's some pent-up demand for a trend following product like this, and trend follow my stocks, please. So the typical managed futures fund, mutual fund or ETF would trade indexes only, stock indexes only, let's say, and their idea would be, allocate a small percentage of your portfolio in case there's a big stock sell-off, crisis alpha type situation, and we will do well with all these different markets in the short stock indices if possible. Whereas our idea was, well, we're actually going to go one step further, one step better, maybe to trend follow those individual stocks as well, and take small losses and have a trailing stop and have some shorts on. So all the great things that CTAs do in the indices, currencies, commodities, and interest rates, let's do it for the single equities as well. And so we've done it, but the hard work is ahead of us. Is enough people going to agree with us that this is filling the need? I like this one saying that a friend of mine came up with, and that is, I want people to want what they need. And I think that what people need and are not getting is trend following of their equities.
So let's talk about this equity sleeve. What does that universe look like? And to piggyback on something you said about just letting the positions run, what exactly does that mean? What does the universe look like? How do you select which stocks to go long, short? And then what does that mean to just let them run? How do you make those decisions to get in, get out, and go long or short?
Right. So the way that we put together the portfolio is putting it in the portfolio markets that add diversification and create some, have less correlation. So it's just purely a strategy that looks for stocks that are different and unusual and are not correlated to the other stocks in the portfolio, just like the same way we would formulate the portfolio for the currencies and the commodities and the interest rates. So stocks, because there's so many of them, thousands, they give us an opportunity to go find those stocks and put them in the portfolio. A lot of the stocks we choose have commodity relationship. They're related to commodities in some way. So we love the commodities. We're getting a little bit more commodity exposure, but it's not just commodity stocks. It's all different kinds of stocks, long and short. And we prefer companies that are below 10 billion, if possible, because we think that they may give us some more outlier and bigger trade opportunities. Companies with one business line, one part of their, not too diversified. We don't want to have a diversified companies. We want undiversified elements throughout our portfolio. But then when we bring them together into the portfolio, then we'll have great diversification.
Is there a point where 300 plus markets, it gets too unwieldy or too diversified? Sometimes I recently had a conversation with somebody who was saying all you really need is 20 positions and you're properly diversified, which I guess is the opposite of that spectrum. So how do you manage diversification that is productive and constructive versus just too much?
Right. I don't think you can get too much diversification. I think the argument could be after 20 or 40 or 50, that's enough. It's not going to, you're just kind of wasting your time. But we don't think that's the case. We are primarily trading a strategy that's going to let the profits run. And we're not going to get out of them until the trend kind of turns around a bit. And hopefully we get our different entry and exit parameters do a good job on that. Sometimes they do. Most of the time they do, but sometimes, they certainly could have done better. But so we're hunting these outlier trades, trying to find the big, huge movers and just spreading it out into lots of different markets. It means those outlier trades are going to spread out as well. Hopefully we'll get maybe 10% of the trades each year will be the big ones, and they'll pay for all the losing trades and have something left over. So we're just sort of spreading out those outliers into more of the data and more of the days and weeks and months so they're not all sort of clumped up together. And that offers a little bit of smoothness to the portfolio versus other methods that CTAs tend to use, which is volatility management or correlation management, which sort of serve to just take smaller profits. So we try to hold on regardless of the volatility and just wait until the market turns around, because that's what our analysis has shown is the best to do. And so in order to keep clients comfortable and less nervous, it's better if we trade a lot of as many markets as possible.
So is that one of the key differentiators here? Like on the details about the fund, you guys go out of your way to point out that TFPN does not target volatility. Is that something that's a key differentiator here in terms of how this strategy works?
Certainly, as compared to managed futures funds and managed futures CTAs, that very few people are left that are trading more of a traditional trend following strategy. They've sort of made up this idea that clients can't handle it. And we're like, well, I think they can handle it. They should handle it. We're here to ask them to eat their broccoli because it's the right thing to do. And letting those profits run and trading lots of different markets will hopefully smooth it out a little bit without sort of the compromises that people have to make if they're sort of adding other features to the trend following, more optimization, more parameters, more rules. So we have just a very few rules. And so in order to get that more palatable performance that people can kind of stay with and have confidence in.
And before I go to you, Jon, I just wanted to complete the thought about just a few rules. So let's dive into the idea of the trend following plus nothing. Why is it that trend following is known for bells and whistles? And is simplicity here so important?
It is to me, and I think I coined this term: one entry, one exit, and a stop loss. So we have like a breakout entry to get long, let's say. Then if the market goes lower, we have a breakout exit, and then a stop loss. And so I think that just those three situations where that it will produce trades. So that's pretty robust and pretty trustworthy way of doing it. It is trend following plus nothing else. Like there's no ball management, correlation management per se, and then other CTAs may put in complementary strategies to trend follow. Well, they hope it's complementary. But I don't like them, like short-term trading or mean reversion, carry trade, pattern recognition, all in this hopes of making trend following more palatable. But I think it's much ado about nothing. So we just coined that term, trend following alone, trend following plus nothing. But, obviously it's trend following everything. We want to trend follow as many markets as possible. We're just always constantly searching for more markets to trade. Maybe we'll trade more commodity markets, or there are definitely a couple of CTAs out there who say that they've found 500 markets to trade. But so who knows, in the future, we'll always be searching for more diversification.
Jon, what do you think this is surprisingly maybe nobody else is doing this? Is it, the number of markets alone that it really requires, this active management you guys are bringing to the table? Why is it that this is a space where TFPN is a disruptor, is an innovator here?
That's a great question. We've been asked that question a lot, even throughout our careers. It's, well, why doesn't everybody do this? And there's a lot of reasons why. Specifically for TFPN, I think the structural difficulty, that perceived difficulty, the process of us going down the path of creating this, we ran into several roadblocks trying to find a lead market maker. And we were told no. If we talked to 9 market making firms, we got told no 26 times. That it can't be done. Nobody's doing this. How are we going to hedge? That we're taking too much risk. The bid-ask spread is going to be too wide. There's a litany of reasons not to do it. But our belief in the strategy, right? Our belief in trend following and how this could help investors in their portfolios, just gave us the impetus to continue on down the path. So I think the structural roadblocks, or the perception that it's hard, is one barrier to entry, if you want to consider it that. But I also think that there's, going back to what you said earlier about somebody just recently told you that 20 markets is all you need. I think that there is that perception that, which is basically an over-reliance on historical correlations, at least in my very nerdy way of trying to express that, where if you just have, the most liquid markets, if you're diversified across the sectors, but you don't have too many markets per sector, and they're mostly based in the US, right? This is this is managed futures 1.0, and this is what typically exists out in the marketplace right now. Well, as Jerry pointed out, that might work in some cases, but when it doesn't work, it becomes the rough edges of that strategy. When it doesn't work, it's too difficult for the investor sometimes to sit through to realize the ultimate benefits of the strategy when they need it the most. And so they end up firing the fund or firing the strategy at the exact wrong time. And I think that also goes into the point of, why it's important to be trend following plus nothing. Trend following is not inherently complicated. I think those that have done trend following the best, it's a very subjective statement, but the Mount Rushmore of trend followers, let's say, have pursued simplicity, right? Jerry being, right on that list. And it's those rough edges. It's the smoothing out of the rough edges, so that you don't continually have to have a conversation about underperformance in a bull market, in an equity bull market, that causes people to add additional bells and whistles to the trend following. And I think that's why it's important to have half your portfolio of markets be geared towards stocks. Because when you get these long running bull markets, from a behavioral standpoint, I think it's more optimal to have an increased exposure to equities, if for no other reason than to keep the investor in their seats during those times where it would otherwise be a drag on the portfolio. And then again, you're back to this continual conversation, if not with yourself, with your advisor, about, is now the right time to fire it? I can't stand the ride anymore.
And I think that stocks, from my point of view, they deserve more of an allocation because there's so many of them. If there was 1,000 commodities, we would trade 300 commodities probably, and or 1,000 currencies. It would be 50% of the portfolio. But stocks deserve to have a bigger weight because they bring more to the table. And I don't do a back test and look at history and necessarily see which stocks I should add. I add the ones that are going to give us the best diversification. So they may have not done well in the past at all, but that's not the way to set it up from a trend following point of view. You want to get that diversification in there first and foremost, and the future is going to look different than the past, although the systems we use should have, and we think they're going to have similar performance. And I think that what I'm trying to do here is trend following is to make the distinction between trend following and managed futures. It's not managed futures. So managed futures is indices. It's things that are in futures markets. So there's no futures markets for the single stocks. So we want to put trend following front and center, create the perfect situation to maximize what trend following can do, and not worry about, well, this is not managed futures. CTAs don't trade stocks; they trade indices. Or maybe some CTAs have another program that they'll have where they trade a lot of stocks, just not going to trend follow them. So it's silly. It doesn't make any sense to us, but that's what they're doing. They're celebrating being in this box. And I'm like, no, I'm going to break out of this box. I'm going to trend follow your stocks. Sell your stocks, put it in this fund. You're still going to have some stocks, but it's going to be trend followed. And it's going to have a different different performance. When you wrap trend following around the stocks, sometimes they're not going to look much like stocks. Trend following has had big fails over the past 10 years when the stock market had just sold off violently in COVID, or other periods where we had these big V bottoms, and as soon as we get short the indices and get out and get short, they go down a lot and they come right back to the highs again, just like a big fail for trend following. Now trading the individual stocks is going to make it a bit better, but I think over the long run we should expect trend following to do better than it has recently, short term. But over the long, all of the data, it does really well at getting you into the stocks at the right time, which seems to be a quandary for a lot of people. When do I get back in? Well, get right back in when the trends reverse. How fast? Well, when each stock that we trade, as it starts hitting its entry criteria, we get back in. And then when do I get out? Well, when the trend changes and we take a small loss. So this is quite a bit. You could still own your buy and hold and your long S&P and your index fund and add this product with lots of stocks in it. You're still going to get a significantly different profile sometimes, most of the time, probably.
But so to that point, I think it's interesting. Well, two things. One is just the point of the systematic approach to it, because it's all about getting investors to stick to a strategy, right? We talk about this all the time. A great strategy can be great, but if you don't stick with it, it won't do much for you. So that the importance of understanding investor behavior and making sure you're delivering something that they can stick with, I think it's brilliant. But the point of the equity allocation. So if we're talking about uncorrelated returns, we're talking about, diversification, but you have a portfolio it's 50%, correct? Like always allocated onto the equity, the risk allocated to equity. So what does that do to your expectations about correlations to just, traditional investments, other equity strategies?
Well, like I said, it's going to be a bit different sometimes. It's going to be better. It's going to be worse, depending upon what the indexes do. Like last year, what was the correlation to bonds? The only bonds were a great trade for us in the worst year for bonds ever. They were a great trade for us because we were short. And so sometimes that's the big deal. Not only do you have all this diversification, but you have it with the shorts. And we always have short stocks as well, just not longs. It's more of a diversified, it's not necessarily 50-50 longs and short stocks, but we have a fair amount of shorts probably almost all the time and longs as well. So it's going to be a bit different than long only, but not all the time. It's going to be, so it may not appeal to people who are dyed in the wool index holders, or they just want a slightly different strategy. But I think adding so many different stocks that it'll help us not to really have a bad period like CTAs did for a long time, about a 10-year period where the only thing trending was stocks. And we didn't really maximize that opportunity because we weren't trading very many stocks. And the trading indices is, with trend following, is so inferior to trading the individual markets. No CTA would trade the dollar index versus all those wonderful currencies, or the commodity index rather than grains, metals, meats, softs, energy, And so why trade the stock indexes? We like to break those indexes apart, choose the right stock, size them the way we want to size them, be long the ones that are going up, be short the ones that are going down, flat the ones that are not going anywhere. Whereas the minute you buy the S&P, even as a trend follower, some of those stocks are in a downtrend. So it just it never made sense to me, just because it wasn't managed futures compliant. I was like, hell with that. I'm trend following compliant. And this is what we want to do. Trend following rules. Trend following is where it's all at. Not watering it down, not adding negatively skewed things to it. And my God, the most famous, most favorite markets that everyone has in their portfolio, they love, even the dyed-in-the-wool trend followers who want to buy TFPN, they love stocks. So we're like, yeah, we love them too, but only to the degree that they help with diversification and they trend obviously just as well as the other markets.
Well, it's thoughtful fanaticism is what we're going to call it.
There you go.
Yeah. I like fanaticism. We usually call ourselves ideologues, joking, but yeah, I like fanatics as well. That's good.
Yeah, it's great. Hey, Jon, let's talk a little bit about implementation. As you guys are out there talking to investors, advisors looking to allocate, how does this strategy fit in? So, given all that we've discussed, the way the portfolio is built, the equities, the diversification, the managed futures, all of that stuff, should you expect this to behave how relative to, say, your large cap sleeve, your SPYs, or even like more broadly a 60-40 portfolio? I mean, how do you look at this fund in the context of a broader portfolio?
Sure, yeah. From an investor's perspective, the expectation should not be that TFPN is going to behave exactly like your long-only bond portfolio or your long-only stock portfolio. Yes, those are components of TFPN, but they're both long positions in some cases and short positions in some cases. So it acts very differently, but that's kind of the point. The point is that you want something in your portfolio that can act very different from the other things in your portfolio. And I think a reasonable expectation for TFPN is that over time, it's going to have positive to low positive correlation to stocks and probably low positive correlation to bonds, making the assumption that those two things gradually rise over time like they have historically. I think where you really get into the behavioral aspect of holding the investment, right? As you mentioned, you can have the greatest solution to an investment problem all you want, but if the end investor can't stick with it, what you really have is worthless. So we want people to be able to stick with this. And I think by design, TFPN gives investors a higher probability of sticking with it because of the equity allocation, but also because of the longer term timeframes employed in terms of the trend following rules that drive the decisions in TFPN. So my expectation would be in long running bull markets, you're probably going to be happy owning TFPN, and in long running bear markets, you're probably going to be pretty happy with TFPN. And then I think it's a random outcome anywhere in between.
Yeah, that's it's almost like an all-weather type of portfolio when you think from a long-term perspective. So, as we get ready to wrap up here, I wanted to just ask, about the actual decision of bringing the strategy to market in an ETF wrapper. To your point earlier, the ETF ecosystem is really complex. There's so many moving parts. You were talking about market making and all the trading and all the complications that exist, with a strategy like this. And so it probably wasn't the easiest wrapper to bring this strategy to market on, but we also know all the benefits of ETF. So, walk us through a little bit about how this decision came. Why an ETF versus a mutual fund? Why buy the fight of exploring the ETF ecosystem to bring this in this wrapper?
I mean, from our perspective, we're trend followers, and this is where the trend is headed. The world is headed to more ETFs, not less, and less mutual funds, not more. So, from 50,000 feet, that was not a tough decision to make. Tough implementation, but not a tough decision to make it, out of the gates. Bringing it out in an ETF wrapper, I think most of these strategies employed in a mutual fund are inherently tax unfriendly. And that is not to say that TFPN will always be tax friendly, but the structure itself and the design of the ETF and the create redemption process inherently gives us a head start and makes the ETF just the wrapper itself, the strategy within that wrapper makes it more tax friendly than, let's say, if it was in a mutual fund wrapper. And then I think there's some, more boots on the ground reasons for bringing it in an ETF construct. We spend a lot of time talking to advisors. So when you try to put yourself in their shoes or their client's shoes, on most major custodians, buying an ETF has a zero commission versus a ticket charge for a mutual fund. That's a little thing, but it means something to people. I think having the intraday liquidity means something to people. And then, having no minimum and making this more accessible. Not that all mutual funds have minimums, but some mutual funds have minimums. And so having a product like this that we think can help a wide swath of investors and really democratizing these strategies to the masses in a way that somebody with 20 million can buy just as easily as somebody with $2,000 can buy. That means something to us, and I think doing that in a mutual fund is much more difficult.
Anything to add, Jerry, to that thought?
Yeah, like I said earlier, I think there's pent up demand for diversified trend following amongst people, retail people who like to invest in ETFs. I think, when I was in my mid-20s working in public accounting, I read about trend following. I thought it was wonderful. I thought it was the greatest thing ever. I fell in love with it. It was just so great in every way, risk control, taking small losses, but then not really compromising any ability to, make a good return. And I think there's a lot of people out there like that, and that who really just love it and want to have trade all these different markets and obviously stocks as well. I think that do-it-yourself people, they start with their stocks trend following, so they're like, I don't know what you CTAs are talking about, but that's all I do is trend follow my stocks. And so it was a lot of pent up demand, and I would get messages on Twitter saying, please do not water it down, make it, you have this full-fledged program and a private hedge fund for high net worth people. Please give us something very similar with all the markets and the same strategy and Jerry's best ideas. And that's what we did. So, you may find 1 out of 20 or 1 out of 40 people who love trend following. That's still a lot of people. And that's what it's for all these ideologues and fanatics, not just John and me, but there's a lot of them out there. I hear from them all the time. So it's really fun to watch, your family members and all your friends who don't have millions to invest to buy a few shares. And so we've gotten a real big kick out of it. But we obviously want it to grow large, and that's going to be due to performance. And we think that we've just set it up for trend following to do really, really well because it is trend following everything out there. And that's when trend following is really going to shine, when it's able to trade all the different markets and benefit from all this diversification.
Yeah, we love to throw around the word democratizer, to characterize the ETF wrapper, which is I don't know, it's almost annoying, that word, but in truth, it's the truth, and it just opens the doors to everybody to access. And I love the idea that this isn't a diluted version, this isn't a second best, this is the real deal. So it's very exciting. As the ETF Think Tank, we track all the ETFs, we talk about them, and this is a product that's very exciting. So I wanted to thank you both for sharing the story today. Congratulations on the launch. It's the Blueprint Chesapeake Multi-Asset Trend ETF, ticker TFPN, Trend Following Plus Nothing. And if you would like to learn more about the fund, check out Blueprint and Chesapeake. And John and Jerry are co-portfolio managers of the strategy. Again, gentlemen, thanks for joining me. Congratulations on the product.
Thank you
for having us.